Do you know how to predict the next price movement just by looking at candlesticks? In this video, I will show you how to analyze candlestick patterns like a pro. Why read candlesticks? Candlestick pattern represent the price movement of an asset over a specific time period, showing the open, close, high and low prices for that period. Each candlestick reflects the battle between buyers and sellers, helping traders understand market sentiment and predict potential price movements. In this video, we will dive into the structure and significance of candlestick patterns and show how they can be used to make informed trading decisions. This is the structure of bearish candlesticks. The top of the body represents the open price, and the bottom of the body represents the close price. The wicks or shadows show the highest and lowest prices during the time period. For a bullish candlestick, the open price is at the bottom of the body and the close price is at the top. The wicks, just like before, represent the high and low points. Here's the body, and you can see the wicks extending above and below. What does the size of the candlestick body tell you? The bigger the candlestick body, the stronger the momentum. The bigger the body, the farther the price moved during that time. The smaller the candlestick body, the weaker the momentum. The smaller the body, the shorter the price movement during that time. Let's start by looking at the USD/JPY Forex chart on the daily time frame. Here we can see a strong bullish trend initially, but notice how the candlestick size begins to shrink. This shrinking of the candlesticks indicates weakening momentum, suggesting that the market may be losing strength. As the candles get smaller, it's a signal that a pullback or correction might be approaching. When the candles become larger again, it could suggest that the trend is strengthening, but keep an eye on the smaller candles that follow, as they might signal the end of the trend. Finally, after the candles shrink and a level is formed, we see two red candles indicating that the price is about to drop. The smaller candles indicate a pause in the trend, and then the red candles confirm the price move downward, signaling a potential reversal. Now let's take a look at the DOJI candlestick pattern. A very small candlestick body or almost nobody at all. A very small body or nobody at all indicates indecision from both buyers and sellers. Price swing up and down, but closest price meaning neither buyers nor sellers gained control. This chart shows the EUR/USD pair on the daily time frame. At the end of an uptrend, we observe a DOJI candlestick, which indicates indecision between buyers and sellers. This DOJI signals a lack of clear direction in the market and is likely to act as a reversal signal. As you can see, after this DOJI, the price starts to decline, confirming that the DOJI acted as a bearish signal, marking the end of the uptrend and the start of a downtrend. To better understand trend changes and recognize these signals, you can watch my videos on trends. where you will learn how to identify and analyze different types of trends. Here we have the bullish engulfing pattern, where the green candle fully engulfs the previous red candle, signaling a potential reversal and the start of an upward trend. The bullish engulfing pattern indicates a strong bullish reversal, where the green candle is larger than the previous one, confirming buying strength. I have pulled up a chart of USD to JPY on a 1 hour time frame, and I found a bullish engulfing pattern. There is a downtrend followed by a large green candlestick that engulfs a smaller red one, signaling a potential reversal to an uptrend. In this section of the video, we can see a bearish engulfing pattern, which indicate a potential trend reversal from bullish to bearish. The bearish engulfing pattern signals a strong bearish reversal, where the red candle completely engulfs the previous green candle, indicating selling pressure. In this chart, the main trend is downward. After a short upward movement as a correction, a bearish engulfing pattern forms. This pattern occurs when a large bearish candle engulfs the previous bullish candle, signaling that the downward movement is likely to continue and confirming the downtrend. It typically indicates that sellers are gaining more control than buyers at that point. The next candlestick pattern we will analyze is the hammer. Let's get more familiar with the hammer pattern, and then we will dive deeper into its details. Bullish candle with a long lower shadow shows a strong buying pressure. Bearish candle with a long upper shadow shows a strong selling pressure. In this chart, we can observe this gold spot to USD, where the price has interacted with a strong support level multiple times. On the fifth touch, the price retraced to this support level, forming a bullish hammer candlestick. This signals that the downtrend is reversing and the uptrend will continue. The price action at this level reflects the battle between buyers and sellers. The formation of the hammer candlestick here indicates that buyers have regained control, pushing the price upward and confirming the continuation of the bullish trend. In this chart of USD/JPY, on the 1 hour time frame, we observe a strong uptrend after reaching a peak. A bearish hammer candlestick forms, signaling a potential reversal. The hammer indicates that sellers have regained control, causing the price to shift from an uptrend to a downtrend. The key and practical candlestick points that should always be remembered. Candles are powerful trend indicators. Understanding the type and the structure of candles helps in identifying price movements accurately. DOJI candle indicate market indecision. They are particularly significant when they appear at key price levels. Bullish engulfing candles signify a trend reversal to the upside. This pattern occurs when a green candle completely engulfs the previous red candle. Hammer candles signal potential reversals in a downtrend. They are reliable buy signals when formed at the bottom of a price drop. Always consider candle patterns in conjunction with the other market indicators. Relying solely on candles without confirmation from the overall market context can lead to misleading signals. Now that we have reviewed the key points, let's wrap up with one final crucial tip. Remember, never rely solely on candlestick signals. Always confirm them with other technical tools such as support and resistance levels, divergences, and indicators to make your analysis more reliable. Thank you for watching. If you found this video helpful, please like it and subscribe to the channel. It truly motivates me to create more content. If you have any questions, feel free to ask in the comments. Don't miss the previous videos and stay tuned for future ones, as I will be gradually covering advanced technical analysis topics on this channel.